Good morning. This is your DealBook daily briefing for Tuesday, August 18, 2026. I'm Andrew Ross Sorkin, and we have a packed edition today, from a billion-dollar basketball saga and a landmark antitrust probe into one of Silicon Valley's most powerful firms, to a deepening global bond rout that's got everyone from the Treasury to the Fed watching nervously, plus a bellwether trial against Meta over social media addiction, and a scoop on an AI voicebot startup that's growing faster than almost anything we've seen. Let's dive in. We start in Los Angeles, where the planned $12.5 billion sale of the Lakers has hit a serious snag. Josh Kushner and Bob Iger agreed to buy control of the franchise from financier Mark Walter, and the expectation was that they'd also buy out the 17.8% stake held by the Buss family. But Jeannie Buss, who also serves as the team's governor, is reportedly fighting her siblings' plan to sell. That matters because NBA rules are strict. A single private equity firm can't own more than 20% of a team, and financial firms in total can't exceed 30%. If the Buss family stake does change hands, Kushner and Iger would need to cover $10 billion in equity or syndicate the deal to other investors. And given the Lakers' cachet courtside seats, championship rings, one of the most storied brands in sports, you can expect a long line of suitors waiting in the wings. Now to the story that's sending shockwaves through Silicon Valley. Marc Andreessen and Ben Horowitz have been among President Trump's most visible champions in the tech world. Both donated millions to his re-election campaign and to Republican causes afterward, and they've promoted the second Trump administration as a boon for artificial intelligence, crypto, and defense startups. Their firm, Andreessen Horowitz, known as A16Z, has become a formidable lobbying force in Washington on AI policy. But that influence may have taken a hit recently, as national security concerns and public backlash have pushed the White House toward a more hands-on approach to the sector. And now, the Justice Department is examining A16Z over the board seats it holds at companies including Databricks and Fivetran, according to Bloomberg. Ben Horowitz sits on Databricks' board. Martin Casado, a partner at the firm, sits on Fivetran's. Both companies help firms manage large quantities of data, and Databricks, recently valued at $190 billion, is one of America's largest privately held startups. A16Z, Databricks, Fivetran, and the Justice Department all declined to comment. This investigation centers on Section 8 of the Clayton Act, a 1914 antitrust law that bars so-called interlocking directorates where individuals serve concurrently as directors of ostensible competitors. The concern, as Duke University corporate and securities law scholar Yaron Neely explained to DealBook, is that if you serve on two companies that are competitors, you can foster collusion. People have been forced to resign after previous investigations. But this case introduces new angles. Past Justice Department cases have largely focused on private equity, though a venture capitalist, Larry Ilg, stepped down from a board in 2022. Perhaps more importantly, previous Section 8 inquiries have focused on individuals, while the A16Z case centers on a firm having simultaneous representation on competitors' boards. That, Neely says, leaves the law more open to interpretation. It strikes at a core practice of venture capital, where firms often invest in multiple companies in a sector to better understand their market. There's a famous Silicon Valley phrase often attributed to John Doerr of Kleiner Perkins: no conflict, no interest. Neely adds that many venture investors will now worry about where you draw the line between two companies that are not competitors and are competitors. The political dimension is hard to ignore. This is a shot at a firm that has championed many Trump policies, and the timing coincides with a broader rethink in Washington about how lightly to regulate AI. As DealBook has previously reported, federal officials are now weighing whether there should be something like an FDA for AI models, a government approval process before new models are released, and the White House is considering an executive order that could increase oversight of new AI tools. Let's move to some other major headlines. L3Harris, a big government contractor that retrofitted a Boeing 747 from Qatar into an Air Force One, has ousted its CEO, Christopher Kubasik, after an investigation into whether he violated the company's code of conduct. Sam Mehta, the head of its space and communications business, is taking over. Kubasik became CEO in 2021. Anthropic, meanwhile, continues its staggering ascent. The AI giant is now on track to generate more than $65 billion in annualized revenue based on current performance, according to Bloomberg. That accelerating financial performance will help bolster its fortunes as it pursues an IPO as soon as this fall. In investment banking, Moelis is hiring rainmakers from LionTree. The firm has recruited Jake Donovan, LionTree's president of Europe, and Aaron Stenzler, who co-founded LionTree in 2012 with Aryeh Bourkoff. Stenzler, based in New York, and Donovan, based in London, will become managing directors at Moelis, which recently advised Jeff Bezos and others in buying a stake in Liverpool FC, and also advised Netflix in its bid for Warner Bros. Discovery. Now, the story that's dominating trading desks worldwide this morning. A global bond rout is deepening as investors fret about the finances of the world's biggest countries. There's another wrinkle: governments are increasingly competing with artificial intelligence giants Amazon, Google, Meta in the debt markets. All issuers, governments or hyperscalers alike, are now competing with more borrowers, Tony Rodriguez, head of fixed income strategy at Nuveen, told Bloomberg. And therefore yields have to be higher. The yield on the 30-year U.S. Treasury bond yesterday hit its highest level since 2007. Bond yields climb as prices fall. The rate on the 10-year Treasury note, which underpins many home mortgages and commercial loans, is trading at a 19-month high. The Treasury Department faces another test tomorrow. It's set to sell $16 billion worth of 20-year debt with what could be another record-high yield. "We aren't pushing the panic button," strategists at Yardeni Research wrote in a note today. However, we are closely monitoring whether the bond vigilantes might do so. Those vigilantes, investors who sell a government's bonds when they think monetary policy has gone astray, have exerted influence over countries' policies for years, and even helped take down a British Prime Minister. Ed Yardeni, the firm's founder, has said bond investors could stymie President Trump, and they appeared to rattle him last year. This connects to a broader story we've been tracking. With Republicans poised to seize control of Congress, Trump's economic plans escalating tariffs, extending corporate tax cuts, introducing tax breaks on tips and Social Security benefits could face little legislative resistance. But the bond market may temper those policies. Some fiscal hawks worry these moves would increase the federal deficit and fuel inflation. And we've already seen how bond yields can force a presidential pivot. Economic turmoil, particularly a rapid rise in government bond yields, caused President Trump to reverse course on steep levies just recently. He went from "be cool," and "this is a great time to buy," to a full reversal in a matter of days as yields spiked. Watch what the Fed has to say next week, as central bankers convene at their annual confab in Jackson Hole, Wyoming. Of special interest is what policymakers might say about inflation amid the war with Iran, especially as Kevin Warsh, the Fed chairman, seeks to tame rising prices. Also watch oil prices. If oil moves higher again, the Yardeni analysts wrote, bond yields could keep rising. Speaking of AI, we have an exclusive scoop today on a startup that's growing at a staggering clip. Sierra, co-founded by Silicon Valley veteran Brett Taylor, has made big gains selling its AI-powered, conversational customer service agents. Taylor is a tech industry fixture, chairman of OpenAI's board, spent 14 months as co-CEO of Salesforce alongside Mark Benioff, was Twitter's board chairman when Elon Musk bought it, and was once CTO of Facebook. His co-founder, Clay Baver, spent 18 years at Google, most recently as head of Google Labs. Sierra's AI voice agents are multilingual and multimodal. Rather than following a script, the agents are given a goal and guardrails, and allowed to reason through their responses, resulting in more natural-sounding interactions. Sierra also tailors them for specific industries, including banking and retail. The company's top customers by annualized revenue include Walmart, Rocket Mortgage, and Cigna. Here's the growth trajectory. Sierra's annualized revenue was $135 million for its 2026 fiscal year, which ended in January, a more than five-fold increase from the previous year, according to documents seen exclusively by DealBook. The company hit $200 million in annualized revenue in May. It projects more than $400 million for fiscal 2027, and about $900 million the year after. But that growth hasn't come cheap. Sierra burned through roughly $140 million in fiscal 2026. It's still well-funded, though. It raised $350 million during that fiscal year, bringing its cash balance to more than $480 million at the end of January. Since then, it's raised an additional $950 million at a valuation of more than $15 billion. Sierra generates revenue primarily through an outcome-based pricing model. Customers pay after a Sierra AI agent successfully completes a task, such as originating a mortgage or processing a refund, not according to usage or number of licenses. Competitors include Decagon, valued at $4.5 billion, and Parloa, worth $3 billion, according to PitchBook. And a few big companies have begun building AI agents themselves using foundation models from AI Labs. Now to Oakland, California, where another bellwether trial over Meta's role in child social media addiction begins today. The Attorneys General of California, Colorado, Kentucky, and New Jersey have accused the social media company of harming children with technology designed to be addictive, like cigarettes, and they're seeking roughly $200 billion in damages. Meta is expected to argue that it has safeguards in place to protect young users and that it did not deceive consumers. The company said last month it spent more than $2 billion last quarter on legal expenses related to the social media addiction trials and other litigation. Whatever the outcome, this will have a significant effect on Meta's business. The lawsuit is among thousands of personal injury and consumer protection cases filed by states, school districts, and individuals against Meta, YouTube, TikTok, and Snap. The cases draw inspiration from the legal playbook used against Big Tobacco in the 1990s. The strategy has already paid off. In March, Meta and YouTube were found liable in a landmark personal injury case in California's Superior Court of Los Angeles County, where a young California woman was awarded $6 million in damages. This month, a New Mexico judge ordered Meta to pay damages totaling nearly $1 billion in a case brought by the state attorney general for violations of consumer protection laws. The companies have settled several other cases headed for trial this year. Lawmakers worldwide are moving to restrict children's use of social media. Countries across Europe, including France, Germany, and Spain, have been considering such restrictions. And U.S. lawmakers have introduced a bill that would strengthen privacy for minors and allow them to opt out of algorithmic social media features. Meta's profit fell 14% recently as AI spending continues to surge. The company increased the lower end of its capital expenditure forecast for the year to $130 billion, up from $125 billion in April, with much of that going to data centers that power AI. Revenue was $60.8 billion, up 28% from a year earlier, but costs jumped even faster. Let's round out with the speed read. Paramount is seeking to force the states suing to block its $111 billion takeover of Warner Bros. Discovery to cover the costs of delaying the deal, asking a federal judge for a $1.88 billion bond from 12 states led by California, plus the Writers Guild of America. A House legislative office that helps draft U.S. laws is reportedly overwhelmed by so-called AI slop. President Trump lashed out at Oman, a U.S. ally mediating the war with Iran. If Oman gets in the way, we'll bomb the shit out of them, he told Fox News as a crumbling truce with Iran officially collapsed. Nico Health, the health tech startup Daniel Ek of Spotify helped found, will open its first U.S. clinic in New York next month. And finally, Gainsay, Concomitant, and Fantods. Why does Bank of America CEO Brian Moynihan speak so archaically on earnings calls? That's your DealBook briefing for Tuesday, August 18th. We'll see you tomorrow. If you have feedback, email us at dealbook@newyorktimes.com. Follow us on Instagram @NetDealBook. Have a great day.